After the common size statement analysis, welcome back to ratio analysis. After making a common formatting to like income statement, a common formatting like representing every item into percentage of sales, balance it every item represented as a percentage of total asset. Now we will try to find out certain more detailed relationship that will be done in the ratio analysis. Ratio analysis make a better comparison through time or between companies. So you can make your own ratio to the previous years. For example, the net profit margin this year is 20%. What was the net profit margin last year? Similarly, your gross profit margin this year is 15% or 20% or 25%, something, whatever gross profit margin comes, you can compare with your previous year. And you can also compare with your competitor. Same year, you can compare with your competitor. My gross profit margin is 25%. My competitor's gross profit margin is 28%. So how I can improve my margin? So like that. Either you can compare through time or between the companies, between companies and competitors. As we look at each ratio, we ask ourselves or you ask to yourself, how is the ratio computed? That's main important thing. What is the ratio trying to measure and why? Each ratio is trying to measure something and why it is measuring, why we are measuring that. What is the unit of measurement? Each ratio has a different kind of unit of measurement. For example, liquidity ratio we measure in unit numbers, 2 is to 1, 1 is to 1. But profitability margins we represent in percentage. Gross profit margin 20%, net profit margin 15%. So one is measured in unitary term, the other one measured in percentage term. So, and for example, market value ratios measured in times, PE ratio 15 times, 18 times, like that. So what does the value indicate? Each one has a different kind of indication. Like profitability, we find in percentage of the sales, and normally, and the market value ratios, we try to find out your price per stock is how many times of your earning per share times. So each one has a different kind of indication. How can we improve the company's ratios? These are the basic questions you have to ask yourself. So different categories of ratios are there. As I was giving you the examples of profitability ratio, liquidity ratio, market value ratios, solvency ratios, turnover ratios. So different category of ratios are there. First one is short-term solvency or liquidity ratios. The first category of ratios, very important, short-term solvency or liquidity ratios. Next category is long-term solvency or financial leverage ratios. So second one is the long-term solvency or leverage, financial leverage ratio. Is the name itself, it is the lever. Lever itself is a long-term. If your lever is not good, it will give you a problem in a long run. So long-term solvency or its leverage ratio. Lever is very important for the for living. Similarly, this leverage ratio is very important. How, we will see. Asset management or turnover ratios. How well you are managing your assets, like total asset turnover, fixed asset turnover, working capital turnover, so receivable turnover, inventory turnover, all the assets, how you are managing. So turnover ratios. Profitability ratios, how you are making, how much percentage profit you are deriving on your sales, like gross profit ratio, net profit ratio, operating profit ratio, etc. Market value ratios like PE ratio, PBP ratio, enterprise value ratio, etc. So here we have the categories of ratio. We will try to calculate one by one. We have the income statement, balance sheet, and cash flow statement of Pufrock given to us. Here is the income statement. Here is the balance sheet of Pufrock. Here is the income statement of Pufrock. So we can calculate the ratio analysis down. So few of the ratios are being calculated here, like current ratio. The formula here is current asset divided by current liabilities, and it is measured in unitary term like 2 is to 1, 1 is to 1, 1.5 is to 1, and in ratio format we represent it. So 1.31 times. So this is always represented in a unitary in a ratio format. 1.31 means 1.31 is to 1. Quick ratio is equal to quick asset divided by current liability. What is quick asset? The asset which can be quickly converted into cash. In the current asset, only inventory can be little delayed to sell, or other items can be quickly converted into cash. That's why in the quick asset means in the numerator we have deducted the inventory from the current asset because it takes some time. So to get the quick ratio, to get the quick asset, we have deducted inventory from the current asset. So remaining are the quick asset, isn't it? So current asset minus inventory is equal to quick asset divided by current liability. For Pufruk, 708 is the current asset, 422 is the inventory. So 708 minus 422 divided by current liability 540. 0.53 time is the quick ratio. That is 0.53 is to 1. For each 1 real of current liability, the company has 53 halala of quick assets. Cash ratio. It is hard cash what you have in your business. Cash divided by current liability. So what we do, directly numerator we put the cash 98 million divided by current liability 540 million, 0.18 time. That means for each 1 real of current liability, you have 18 halala of cash. So that way we make the interpretation. So dear friends, here what we can do, you can see here the unitary measurement. We find 3 ratios for liquidity. Then comes 3 ratios, 3 formulas. There is a trick here. What is the trick? All the liabilities are current liability. All the denominator are current liability here. Check it. The trick here is for liquidity ratio. The trick is denominator is current liability. First ratio, second ratio, third ratio. All ratios, denominator, current liability. Numerator is the ratio itself. If it is, because numerator is the test of asset, right? So current asset, if it is current ratio, current asset. Quick ratio, quick asset. Cash ratio, cash. So no need to by heart any formula. If the formula comes, just use your, it is a liquidity ratio. That means the denominator will be current liability. Numerator will be what is asked. If quick ratio is asked, I will put numerator quick asset. Quick asset means current asset minus inventory. If the ratio is cash ratio, it is a liquidity ratio. Liability, current liability will be the denominator. Okay, it's a standard. And numerator will be, because it is cash ratio, numerator will be cash. Like that. Next. Second category of ratio is leverage ratios, which is very long-term solvency ratio. The liquidity ratios are short-term solvency ratio. The leverage ratios are long-term solvency ratio. So first one is total debt ratio. You know, in the total asset side, if you see the balance sheet very carefully, for example, go to the common size balance sheet. If you go to the balance sheet carefully, you find if you deduct the equity portion, that is 2299 total equity, if you deduct from the total liability and equity, if you deduct the total equity, remaining is the total liability, isn't it? You need the total liability. So total liability is equal to total asset minus total equity, isn't it? Total asset minus total equity is equal to total liability divided by total asset. So total debt ratio is equal to total asset minus total equity divided by total asset. Why? In the numerator, we need the total debt. Total debt is equal to total asset minus total equity, because the assets is financed by debt and equity. So if you want the debt, you deduct the equity from the asset, you will get the debt. Balance sheet identity we have seen in the chapter 2. The assets is equal to liability plus capital, or liability is equal to asset minus capital. Therefore, here we need the total debt, total asset minus total equity is equal to total debt divided by total asset. For PUFROC, the total asset is 3588. The total asset is 3588 for 2019. The 3588 is the total asset minus 2591 is the liability. The total equity is 2591. You see 2591 is the total equity. 3588 minus 2591 is equal to total debt divided by total asset 3588. 0.28 times. So debt is 20.28 times and equity is 1 minus 0.28 is equal to 0.72 times. Debt equity ratio. Total debt, the ratio itself gives, you see, debt equity ratio. So numerator is total debt, first one is numerator, second one is denominator. Total debt divided by total equity. In PUFROC, the total debt is 0.28 time, and in each $1 of asset, 28 halala is debt. That means above we calculated 0.28. So 1 real of asset, 28 halala is debt. So 72 halala will be equity, because debt plus equity is equal to asset. If $1 is the total asset, 28 cents is debt, that means 72 cents is equity. We need the debt equity. So total debt is 28 cents divided by total equity is 72 cents. So debt is, and cent is always written as 0.28 divided by 0.72, 0.38 times. Or you can write total debt divided by total equity. Total debt and total equity, where it is given, total debt is equal to, here the total debt is given divided by total debt is equal to long-term debt plus short-term debt, total debt divided by total equity is equal to 0.38 times, you see, 0.38. You can see here 0.38, you can see here 38. You reduce the decimal, so it will be 0.38. Yeah. So what I have done, in the numerator I have written the debt, denominator I have written the equity. Equity multiplier. Straight cut formula is total asset divided by total equity. Total asset divided by total equity. So equity multiplier, this is the debt equity ratio. Debt equity ratio calculated here. Equity multiplier or financial leverage. Equity multiplier is equal to total asset divided by total equity. Total asset is 337, the 3588 is the total asset, divided by total equity. Total equity is 2591, 1.38.
So, doctor, what does it mean to have 1.38?
1.38 time of your equity is the total assets. The assets of the business is 1.38 time of the equity. Okay. If your equity is $1, then your total asset is $1.38. Because your $38 is debt, so your total asset will be debt plus equity. So for each $1 of equity, how much amount of total asset is there? It is representing. So here, for $1 of total equity, $1.38 of total asset is there in the business. Okay?
Okay.
So, or else we can do total asset is equal to, as per the balance sheet identity, total asset is equal to total debt plus total equity. So, in the numerator, we can write total debt plus total equity divided by total equity is equal to total debt divided by total equity plus total equity divided by total equity is equal to 1 plus total debt divided by total equity, or 1 plus debt equity ratio. That is equal to 1 plus debt equity ratio calculated over 0.38 times. Directly you can calculate. Debt equity ratio is 0.38 times. You need not calculate equity multiplier. If debt equity ratio is 0.38 times, if someone asks you multiple choice question, if debt equity ratio is 0.38, what is the equity multiplier? Straight add 1 to that. Once you add 1 to debt equity ratio, you will get the equity multiplier. So another way of calculating equity multiplier is 1 plus debt equity ratio. Here a debt equity ratio is 1.38 times. 1 plus 0.38 is equal to 1.38 equity multiplier. Alright. So that is 1.38 times. Or else you can calculate directly by total asset divided by total equity, that comes to 1.38 times. So coverage ratio we will take in the next class. Okay, so we will stop here. Just a minute, let me stop the recording.